Thanks for joining me today. At DayTradeToWin, we don't just focus on day trading. We really look at a bigger picture. The primary focus is day trading, being in and out during the same day, but there's also position trading that we should be aware of. And if you're able to hold a position overnight, a little bit larger of a margin when holding a position overnight, always check with your broker. It's risky. Check with your broker. Make sure you ask the right questions before you decide to risk any money that you have. When looking at this type of trading, we're holding on to a move multiple days in a row, looking for a larger profit. That's what swing trading is all about. But let's do it right. Let's just not throw ourselves into the market. I think that's risky. Let's do this with some rules. And if you go back and look at all the videos that we have, either on the Day Trade to Win YouTube channel or on the Day Trade to Win videos page, for the last 10 years or so, I've been teaching the January effect, and every year it always comes out very positive on the expectation, but we have to, like I said, do it right with rules. Now, that doesn't mean this year is going to be an absolute winning year. All the trades are going to be 100%. It just means, based on history, we can tell that if the January closing is higher, then the entire year should be constantly moving higher and higher and higher. Now, it doesn't mean the opposite. If January month has a lower close and open, the market's going to go down. It just means that because January was an up month, it closed higher than where it opens, we can expect the market to move higher throughout the year. Now, moving higher throughout the year doesn't mean buying it and then walking away. Let's use some rules. This is my recommendation on how you would approach this method. We're looking at first seeing if January is in fact closing higher than where it opened. This is January 3rd, 2017. This is January 31st going into February 1st, 2017, and it's obviously up month. Looks something like this if you look at a monthly chart. Now, as we go forward in time, definitely an opportunity to buy it if it breaks out and moves higher. Sure, why not? It's a little risky. I would wait 2 or 3 points of breaking this high before jumping in. That's usually better because markets love to test where they've been, and you could just be looking at a double top. I believe that going a little bit more conservative, waiting for a pullback, has a better option. So when you see the market giving you a significant pullback, so you see all of this here beginning to pull back, this is in March, you have a new opportunity now to buy this market as it tests the highs of where it has previously been. As an option, where do you buy it? You can look at what I recommend, and I prefer 50% from the highest high to where it pulled back and now it's coming back. A couple of points above, you're going to go long. The goal is to see the market reach the highs, testing the highs. That's really the goal. But for those of you who don't want to wait that long, I have an alternative option. Let's take a look at the current conditions. The ATR is something I use. You can take a look at all the videos, probably over 400 or 500 videos at the moment, teaching and showing all these things about the ATR, how to swing trade, day trade. This here is telling me about 17 to 18 points is my goal based on the current conditions, which means I can expect the market to go 18 points up. And from here to here, the market moved 40 points. So what happened? Market went up, tested the highs. The 18 points was no problem. It actually made the full 40, testing the highs that were previously made. Now, that being said, if you see the market is starting to turn around and not go up as it did here, I don't think you should hold on to this entire move to the downside because it could be very painful to see this go against you. So I like to have a stop that is just under where it pivoted and came back up. That would be the best opportunity. And it never broke it. So in actuality, that was the right stop. But if you see it starting to go against you, you don't have to have this much of a stop or larger of a stop. Just get out of the trade. And then if it starts to come back and break again, I would take the trade again. And now If you look at a second time, this happens in May, May 2017, a very significant pullback, and now it starts to come right back to test those highs. What's the goal? The goal would be 30 points. That's testing the highs. In actuality, you can probably expect 23 points. This, in my opinion, would be just a wiser decision. And then you can trail a stop if you want, reaching the highs that were made. Remember, markets love to test where they've been. I say it all the time. I say to all the students, markets love to test where they've been. Now here we are again in June. Look at 1, 2, 3, 4, 5, 6, maybe 10, 15 days. Market retraced back 50 points. So what are we going to do? Go long when the market breaks a few points above the midpoint. The goal is to see it test the highs, and this is your stop down here. And just like this would have been your stop down here, a few points below, I call it a pivotal stop. With most of the teaching that I do, pivotal stop is what I refer to it as. And as soon as the market went and broke the high, the midpoint, 24 points. But like I said, 1 times the ATR, about 17 points. Now here we are in the July going into August. We have, I would say, 2 or 3 more opportunities until the end of the year to see it once again. And you don't have to trade it live. You can sim trade it. You can test it. You can go back in history. You can email me if you have any questions on it. But it's very accurate. Look at the market at some point in time, retrace, and then start to come and test where the highs, wherever they happen to be, it's going to want to test those highs. You don't have to take that full target. You can take 1 times the ATR, but remember to put the 50% retracement tool a few points after it breaks your long, start trailing a stop, see it end up to here. If it starts to reverse and come back down, you don't have to hold on to a large stop. You should get out, and if it starts to break back above again, especially where it tried and failed here, take it again. You got it, guys. Any questions? You got it, Roger. All right, Milton. Have a great rest of your day. This is the January effect. This is something that we teach at Day Trade to Win. Look through all the historical videos showing this in actual